Let's be honest, investing can sound complicated when you're just starting out. You hear terms like ETF, index fund, expense ratio, diversification, and your brain just goes, wait, what? If that's you, you're in the right place. In this video, we're going to break down how to choose the best ETF or index fund for your very first investment, step by step, in the simplest way possible. By the end, you'll know what ETFs and index funds actually are, what makes one better than another, and exactly what to look for when choosing your first one. You'll walk away ready to invest confidently, even if you've never bought a single stock before. But first, a quick disclaimer. This is an educational video and not financial advice. The purpose of this video is to equip you with the basic understanding about investing in funds, so it's easier for you to start your investment journey. Quick refresher. What are ETFs and index funds? Before choosing one, let's make sure we're on the same page about what these terms mean. If you want to dive into more details, I've already made a detailed video comparing different types of funds. Make sure to check it out. Think of an index fund or ETF as a basket that holds a bunch of different stocks, or sometimes bonds. Instead of buying one company like Apple or Tesla, you're buying a little piece of hundreds or even thousands of companies all at once. For example, an S&P 500 index fund gives you ownership in 500 of the biggest U.S. companies, like Apple, Microsoft, Amazon, Google, and so on. If the overall market grows, so does your investment. This gives you instant diversification. If one company performs poorly, the others in the basket help balance it out. Now, what's the difference between an ETF and an index fund? Index funds are bought directly from the fund company like Vanguard or Fidelity. They're priced once a day after the market closes. You tell them, invest $500, and they simply handle it for you. ETFs, on the other hand, trade on the stock market like individual stocks. Their prices change throughout the day. You can buy or sell them anytime during market hours through a brokerage app. They both do the same job, track an index, but the way you buy and manage them is a little different. If you prefer a set-it-and-forget-it approach, go for an index fund. If you like flexibility and control, go for an ETF. Both are great for beginners. The right choice depends on your style, which we'll get into shortly. Step 1. Define your investment goal and timeline. Before choosing a fund, you need to answer one question. What am I investing for? Are you building wealth for retirement? Saving for a house 10 years from now? Or just trying to start small and learn? Your goal determines your time horizon, how long you'll keep your money invested. ETFs and index funds are designed for the long term. The longer your money stays invested, the more you benefit from compounding, which is when your money earns profits, and then those profits start earning profits too. If you plan to use the money within a year or two, this isn't the right investment. The stock market can go up or down in the short term, but if your time horizon is 5, 10, or 20 years, that's where ETFs and index funds shine. Step 2. Pick which index you want to track. Next, decide what part of the market you want to invest in. Every ETF or index fund is built around a market index, basically a list of companies it tracks. Here are a few popular ones. S&P 500 Index, 500 of the largest U.S. companies. Great for beginners who want exposure to major companies. Total Stock Market Index includes large, mid, and small companies. Gives you the entire U.S. stock market in one fund. International Index includes companies outside your country, adds global diversification. Bond Index focuses on government or corporate bonds, lower risk, lower return, and good for balancing your portfolio later on. If you're just starting, a broad market index like the S&P 500 or Total Stock Market Index is usually the best option. You'll be invested in hundreds of companies, so your risk is spread out and you don't have to worry about picking winners. Step 3. Compare similar funds tracking the same index. Once you've picked your market index, you'll find multiple funds tracking the same thing. For example, there are several ETFs that follow the S&P 500, such as VOO, Vanguard S&P 500 ETF, SPY, SPDR S&P 500 ETF, IVV, iShares, S&P 500 ETF. All three invest in the exact same companies. So, how do you decide between them? You look at a few key factors. 1. Expense ratio. This is the annual fee you pay to the fund provider. It's expressed as a percentage, for example, 0.03%. That means for every $1,000 you invest, you'll pay 30 cents a year. It doesn't sound like much, but over decades, lower fees mean more money in your pocket. Always compare the expense ratio. Lower is better. 2. Tracking error. Each fund tries to copy the index as closely as possible. Sometimes small differences occur. That's the tracking error. The smaller the number, the better the fund is at matching the index's performance. 3. Liquidity and fund size. This tells you how popular and stable a fund is. Larger funds, those managing billions in assets, are generally easier to buy and sell. They also tend to have lower trading costs. 4. Dividend policy. Some funds automatically reinvest dividends. These are called accumulating funds. Others pay dividends out to your account, called distributing funds. If you're in growth mode, accumulating is simpler. If you want passive income, go with distributing. Step 4. Choose a trusted fund provider and platform. Next, look at who's behind the fund. Stick to large, reputable providers like Vanguard, iShares by BlackRock, Schwab, Fidelity. They're known for low fees, strong performance, and reliability. Now, you'll need a brokerage platform to buy your ETF or index fund. Choose one that is regulated in your country, has low or zero trading fees, offers fractional shares so you can start small, and is easy to use for beginners. If you're outside the US, look for platforms like Interactive Brokers, eToro, or your country's local brokers that offer ETFs. Step 5. Decide between ETF or index fund. Now that you've compared everything, you need to decide which format suits you better. Choose an index fund if you want to invest automatically every month, hands-off, without worrying about timing the market. Choose an ETF if you prefer flexibility, being able to buy any time and possibly avoid minimum investment limits. In reality, you can't go wrong with either. Both will give you nearly the same returns if they track the same index. The difference is just how you buy and manage them. Step 6. Start small and stay consistent. Many people delay investing because they think they need a lot of money. You don't. Start with whatever you can, $25, $50, or even less. What matters is consistency, not the amount. This approach is called dollar cost averaging. You invest a fixed amount regularly, every week or month, no matter what the market is doing. Sometimes you'll buy when prices are high, sometimes when they're low. Over time, it averages out, reducing your risk and smoothing out market ups and downs. It's a simple but powerful way to build wealth without stress. Step 7. Focus on the long game and stay patient. ETFs and index funds aren't meant to make you rich overnight. They're designed to grow your wealth steadily over years using the power of compounding. That means your profits earn profits, and your money grows exponentially the longer you stay invested. Let's say you invest $200 a month and earn an average return of 8% per year. In 10 years, you'll have about $36,000. In 20 years, that becomes $118,000. And in 30 years, that'll be over $270,000. That's the magic of time and consistency. So don't panic when markets drop. Don't try to time it. Just stay the course. The best investors don't check their accounts every day. They stay consistent, patient, and focused on the long term. So, to sum it all up, define your goal and timeline. Pick a market index to track. Compare funds using expense ratios, tracking error, and fund size. Choose a reliable provider and platform. Decide between ETF or index fund. Start small and invest consistently. Think long term. Remember, investing isn't about predicting the market. It's about owning a part of it, staying patient, and letting time do the heavy lifting. That's it. You're now miles ahead of most beginners. If you found this video helpful, hit the like button, subscribe for more beginner-friendly finance videos, and drop a comment below with what fund you're considering. Thanks for watching.
Investing isn't about getting rich quick, it's about getting rich eventually. And with patience, you'll see the rewards.